Hello friends, clients, and fellow financial advisors. My name is Ron Bullis and I'm the CEO and co-founder of Lifeworks Advisors. My guest on today's show is someone who has a very unique background. He's the CEO and founder of Eaglebrook Advisors, which is an RIA that was created specifically to provide digital asset investment strategies and separately managed accounts for firms and advisors and their clients. His background isn't as a financial advisor, but rather as somebody who came out of the VC space and who's been focused on cryptocurrencies and digital assets since he started his professional career. The conversation around cryptocurrencies, digital assets, NFTs, tokens, etc., is one that I believe advisors should be leading for their clients, not following passively. I hope you enjoy this wide-ranging conversation and gain some valuable insights into how you can help your clients make wise decisions as it pertains to whether or not they should be thinking about or investing in cryptocurrencies and digital assets. Welcome to the Future of Advice, Chris King. Chris, it's great to have you on the Future of Advice. This is something that's been over a year in the making. The aligning of two founders of startup investment companies seems to be harder than I thought, but I'm really excited to be here. We're in Hollywood, Florida, at the Diplomat Beach Resort. It's a fantastic place. So thanks for making the trip up here from Miami to record the interview.
Of course, Ron, thank you so much for the opportunity. And it has been a long time coming. So we met about 2 years ago. So now we've been planning this for a while and finally our paths aligned. So very excited for this conversation.
Yeah, I think you and I first connected right after Lifeworks was part of the Scratchworks season.
Yes.
I think is what it was. And correct me if I'm wrong, but I think Marty Bicknell also is one of your lead investors in Eaglebrook as well. Yeah. So I've been talking about this forever, so it's excited to do it. So let's jump in. Let's start with the assumption that everybody watching has no idea who Chris King is or Eaglebrook Advisors. So a little bit about your background, and let's go into your firm after that.
Yeah, of course. So my name is Chris King. I'm the founder and CEO of Eaglebrook Advisors. We are a tech-driven investment manager that specializes in Bitcoin and digital assets. What we do is we operate one of the largest separately managed account platforms in this market. So you probably hear about people wanting to invest in a Bitcoin ETF or private funds or public trust like GBTC. We kind of fill that gap where advisors want a direct exposure. So we give them a direct offering where we do all the investment management, trade execution, reporting, integration, billing. So it's a very holistic approach. And then obviously we will also do a lot of the education and training as well. So we'll obviously get into what we do at Eaglebrook. But my professional background is in venture capital. So previously worked in venture capital at one of the largest crypto venture funds, investing in companies like Coinbase, BlockFi, Bakkt, and Bitwise. Basically the companies that were providing certain investment solutions for different groups of customer bases, all the way from retail to institutional. While I was there, I was looking for a company that was building investment solutions for wealth managers and financial advisors. That's because my dad's a financial advisor. He's been an advisor for the last 30 years. And I understood how he worked with clients, how he ran his practice, how he diligenced alternative investments. And I kept hearing, hey, I want exposure. How can we do this? What's the best way to do that? So given that understanding of both building secure, compliant, scalable infrastructure in the crypto market and my background in understanding wealth management, I decided to start Eaglebrook. It's funny because everyone in crypto, they don't even know what an RIA is, right? They don't really understand.
You're putting together two industries that could not be farther apart.
Yeah, and then everyone in wealth management, a lot of advisors saying, oh, this is tulip mania, this is a fad, and I don't really want to understand that. So I thought it was a huge opportunity to really bridge that gap, both from an education standpoint, but also from an access and outsource investment management standpoint. So that's kind of the background. Started it in 2019. Okay. We ended up raising capital from mainly wealth management executives, like you said, Marty Bicknell, founder and CEO of Mariner Wealth Advisors, Mike Alfred, who has built a data company in the RIA space and the crypto space, as well as Mark Cassidy, who's the former CEO of LPL Financial. So kind of sat in a room with a lot of these executives and decided that the best solution was a separately managed account platform. However, no one had built that in the crypto market before. It's on a completely different, financial system, different custody, trading, regulations, all of those things. So we built the first SMA platform. We did the diligence on all of the digital asset custodians in the US, their regulatory structure, their functionality, compliance, all of these things. And they hadn't been working with many wealth managers or RIAs, so we decided to get our RIA license as well, so we would be regulated just as our initial clients were. We started building the platform out in November of 2019. It took us about 12 months to really build everything out.
I would just imagine sorry to interrupt you, I would just imagine taking an industry that has almost no regulation, the digital asset space, specifically thinking, cryptocurrencies, we'll pick on that, make it a ubiquitous term. Taking an industry that has almost no regulation at the time, and then taking what I would still consider to be one of the highest regulated industries, the wealth management space, and putting those together. You're certainly a glutton for punishment. So you were at Morgan, I think it was Morgan
Creek Capital.
Morgan Creek Capital on the VC side. Your dad was an advisor. He starts asking you questions, and then you have this kind of catalyst, galvanizing moment where you're like, there are other advisors that are going to need this. Let's start a firm to do it. Walk us through the order, just because I think one of the things I want to talk to you about in here, and maybe this will be a fine segue at the beginning of the interview, is the opportunity that exists, I think, for advisors and even firm owners that are listening to this to maybe rethink how to grow a practice, sort of potentially, position their firm to take on outside capital for growth. And so walk me through just the process. Did you create the technology company first and then realized, hey, we need to create an RIA so we can kind of have some of the done for you research and compliance pieces? Or did you have to create everything at once? And it seemed a little bit boring, but I want to pick apart how you started the firm and also maybe talk about how the other advisors, maybe not in the crypto space, but thinking about growing a next generation firm or the firm of the future could learn from that in terms of capital structure and opportunity.
Yeah, so I'll touch on all that. So got the RIA license first because I realized if we were going to be working with RIAs, we wanted to have the same exact regulatory structure and documentation so they felt comfortable with, okay, they're regulated like us, we will work with them for this piece of our portfolio, which is the digital asset market. So that was kind of the first piece of it. Once we got our RIA license, we're working with our regulatory counsel, our compliance consultants. We then had built the technology based on the advice there. So we didn't want to start writing code until we understood exactly what we needed. SEC custody rule, monthly and quarterly account statements, SLOAs, everything you could possibly think of, we had coded in the platform. I also was blessed, our CTO, Chris Johnson, he's a JD MBA, and he's an engineer, so he can comb through all of the diligence documents.
An attorney that's also a software engineer.
Exactly.
So on the technical side.
So he helped out a lot with making sure we coded all of the compliance into the platform, but also documenting it. So when we work with a firm like yours, you can go through our due diligence, compliance diligence, the checklist, all of those things, and understand, hey, all of this is coded into the platform. You just need to walk through it, do the diligence and approve it, just like any vendor that an RIA would use. Thinking about how advisors grow their practice in relation to crypto, I think there's two really interesting opportunities. The first is that 22% of advisory clients own Bitcoin or digital assets, but only 3.5% hold it with their advisor. So there's a lot of capital that is outside their purview. We're working with someone like Eaglebrook. Those assets can be transferred to us, and then they can be integrated to your system through your portfolio management system, whether you use Orion or Adipar or Black Diamond, whichever firm. So you can report, model, and bill on those assets. So that's kind of one thing is your clients aren't going to tell you, hey, I have $250K at Coinbase. But if you say, hey, we have a solution that you can now bring it into our practice, it can be part of your financial plan, estate planning, asset allocation models, rebalancing, all of those things. That's a really interesting opportunity there, and that's only going to grow, right? So it's kind of helping bring more assets to the platform. The second I would say is differentiation. So another interesting statistic is that 62% of advisory clients say they would leave their advisor to go with another advisor that is at least knowledgeable about Bitcoin and can provide access to Bitcoin. So that's a really interesting number. So it's a really big business opportunity and a way for advisors to differentiate themselves in a market where, when you're an advisor, there's a lot of the same services. Say, hey, I'm an expert in this. I know you're looking for exposure.
Yeah.
Let me help you, and we
Yeah.
work with a great firm.
That number, it shouldn't surprise me, because I think my experience in talking to the advisors on my team and advisors around the country is that they're getting asked about these things all the time, which is why I thought this interview would be really great for advisors to hear. But a majority of clients saying that they would leave their advisor for a firm or an advisor that's knowledgeable in this space, that's very interesting, because there's a lot of studies, I shouldn't say a lot of studies, there are research reports out there that talk about how sticky clients are to their advisors, right? Even clients that are unhappy oftentimes look at the pain points of like changing advisor as being worse than like staying with the advisor who maybe they're not happy with. So let's jump to regulation, right? As I look about kind of our industry, I think the demographic makeup of advisors, there's a lot of stuff out there about the average age of an advisor being closer to 60 and next-gen advisors being in the minority. But there's also this dispersion where I believe the largest percentage of advisors are still registered with like large firms, banks, independent broker dealers, and like I came out of the insurance company space. What are the challenges that you're seeing for advisors in firms like that? A small RA like Lifeworks Advisors, or even a larger RA that can control their compliance and say yes to it. I could see them adopting, working with you. But for the hundreds of thousands, maybe 150,000 advisors that are at, the largest firms, what are some of the uphill challenges that you've been running into for them in terms of getting a big firm to be open to the conversation about their advisors adding crypto to their clients' portfolios?
Yeah, that's a great question. It's a big part of our growth plan.
Yeah.
I think the biggest thing is that a lot of them aren't even allowed to talk about Bitcoin because they don't have approved offerings. However, some firms are actually moving into allowing, I think, Bitcoin private funds. So I think Morgan Stanley recently announced something, Wells Fargo, JP Morgan said, hey, we're going to allow our clients to own the public trust, so GBTC, BitW. You have to sign all the disclosures and all those things, but they're moving towards that.
Yeah.
However, our view is that from our conversations with a lot of the big wires and IBDs is that the SMA structure makes a lot of sense, but it just takes a little bit more time to get through compliance, legal, and risk. And it's also a chicken or the egg problem where right now we're approaching 100 million in assets, but a lot of those firms need you to have 300 million, 500 million, a billion.
Just to qualify to get on their
2-year
platform.
track record. Yeah. So a big part of our growth plan is to get approved on those platforms, educate and train those advisors so they can have articulate conversations with their own investor clients. But I think that just takes time. Over the next 12 to 24 months, I think we'll see a lot of these firms approve a direct offering, which is typically in either the SMA structure or going directly to a Coinbase and building out their own technology or Gemini or something like that. But that would take, a big firm is going to take them 12 to 24 months, or would they rather build or partner? Most likely they're going to partner.
So the last couple of years has been a lot of talk about a Bitcoin ETF. But ignoring the ETF, because it seems like that's on the proverbial next year track, I don't know whether they're kind of unified in this front, but walk us through the SEC's position on, an advisor giving advice to a client and recommending, say, Bitcoin in their portfolio, and then also FINRA, because I know they're kind of like brother, sister on the regulatory side or some kind of relationship, depending on how you want to look at it. But they can also diverge in terms of their guidance for advisors around, knowing your client and suitability and Reg BI and stuff like that. Walk us through what exists right there for those of us that are advisors.
Yeah, so the short answer is that we would like more regulatory guidance. We embrace regulation because it makes our job easier. However, I think the checklist for what you need to do is fairly simple. It is making sure you're doing the suitability checks, right? You're not investing too much of their net worth, right? So some of our clients will cut it off at 6%, so they won't allow any of their clients to go over 6%, but making sure it's suitable on a client-by-client basis. And I think there's a difference between offering it on a non-solicited basis. Hey, my client wants to buy 100K worth of one of your Bitcoin and ETH strategies, or on a solicited basis, that's where things get a little bit different, where you need to provide the proper disclosures, document all the conversations with the client, update your ADVs that you now work with, digital assets. So adding all the digital asset risk disclosures, adding certain attestations to the client agreement. So that's kind of something that seems daunting, but is fairly straightforward, and we can walk you through that. Their view is that you can do it. It's just you need to provide over disclosure. You need to understand what you're investing in. You need to do the diligence on the vendor as well as the regulatory diligence on the asset. Bitcoin and Ethereum, the regulatory guidance for the CFTC and SEC for those specifically are somewhat clear, but there's also hundreds of other assets that are investable that there needs to be more regulatory clarity, and there's a lot of client demand for DeFi assets, other layer ones, Ethereum competitors, layer twos, things like that. So that's where things get interesting from.
Are the regulators treating this essentially then as some other highly speculative type of investment? I mean, I think the word speculative gets tossed around a lot when I'm reading compliance stuff or regulatory stuff. But essentially, is that how they're approaching it, as kind of a buyer beware type of thing right now?
Yeah. So I think part of a piece of it, and what all our firms do, is they do advisor training and a certification program, whether it's internal or external with our training platform or their own training platform. So I think that is a big piece of educating the clients on that. So that's I think the biggest piece of how they're looking at that from a client and advisor perspective.
One of the challenges, and it strikes me as interesting because I think you can look at tax policy and what the IRS's policy are, and you can kind of see directionally maybe where the government's going with this. But I think it was in 2020 that they added for the first time a question, basically right after your name and address. Have you had any crypto transactions in the last year? There's been some talk about the IRS guidance treating this as an asset, not as currency. What are you guys seeing there? What's the impact of this been? And do you think the IRS is going to be ramping up reporting, auditing, investigating firms, advisors, and clients that are involved in the crypto space?
Yeah, that's a great question. So we do all the tax management for our clients. It's typically IRS Form 8949. Okay. If you have over 200 transactions, then the qualified custodian will issue a 1099. However, most of our clients are buying and holding, rebalancing on a quarterly basis, semi-annual basis. So that's
200 transactions in a year. The tax statement's coming directly from, say, a Gemini or a Coinbase or whoever the digital custodian is. For the under that number, you guys at the RIA level are doing that for me, the advisor, and for my client.
Yes, that's correct. And then from a tax perspective, viewed as commodities by the CFTC and SEC, by the IRS, it's actually treated as property where there's no wash sale rule. So right now there's no wash sale rule. However, there is a bill in the House right now that would actually make it have to have the wash sale rule. Yeah. But there are other tax strategies that you can use similar to traditional investing. If you have a multi-asset crypto portfolio and you want to sell something and buy something that has a similar correlation in the portfolio, there's other strategies you can do. So a big advantage of SMAs is that tax optimization and tax efficiency, which is the reason why a lot of people like SMAs in the traditional world as well. And obviously the benefits of direct ownership, no tracking error, execution in your name are major advantages.
Yeah, you actually hold it, right? So if you're looking at, and we'll get to this maybe when we talk about strategy, if you're looking at, cryptos as maybe akin to gold or some kind of hedge against, the debasement of fiat currency or bad monetary policy. But so I just want to make sure I'm a couple more questions here, which is, I find this to be very interesting because I think there's a lot of misinformation out there about the requirements around tax reporting and things like this. So the gains on the sale or the loss on the sale of these are treated like capital gains, capital losses. So same 12-month holding rule.
Exactly.
So theoretically, if somebody had, cryptos in their portfolio and they had a really bad run, they could sell those off, use them to balance out gains in a different part of their portfolio, come back in. Because you said there's no wash sale rule.
Yes.
Right. So expound on that just a little bit more. I'm assuming every advisor listening is probably familiar with what the wash sale rule is for individual securities, but walk us through what that wash sale rule is and what that opportunity or challenge then looks like for tax loss harvesting in the crypto space.
Yeah, so you don't need to wait 30 days like you do for security because Bitcoin,
Yes.
Ether, other digital assets are not securities. So say a tax lot falls by 10%, 15%, whatever threshold you decide, we'll actually sell that and then buy that same lot or buy that same asset back within 60 seconds and then move it back to their cold storage custody account, which is very advantageous because they materially own the same amount of Bitcoin or Ether or digital asset, but then they have that short-term or long-term capital loss to defer taxes at the end of the year. And in such a volatile market, that tax arbitrage is very advantageous. And as you know, advisors provide a lot of value by doing a lot of the tax management. So we've seen a lot of clients very happy with kind of how we've done the tax management for their specific accounts. I think we've done like 5,000.
We've talked about this a little bit because, and I figure, whenever there's a free lunch or something that's too good to be true, some regulatory body or the government will come in and, put a stop to that. But the ability to sell something, recognize gains or losses, and turn around and immediately rebuy the position strikes me as a really unique opportunity, especially if you're owning crypto and you're bullish on the long-term outlook of it. And for whatever reason, China says, individual, virtual currency transactions are now prohibited. You can hold it, but you can't use it to buy and sell stuff. Crypto tanks for a little while. Like, you guys could go in and sell during that down run, immediately buy back, and we could book a big chunk of losses to use against our gains in the traditional asset space. Correct?
That's exactly correct. And that's how our clients and advisors are looking at this now. And it's just a huge opportunity that is not well understood, I would say. So, however, there's a bill that does have that.
Is it part of the broader tax reform bill that they're trying to drive through? Okay, part of the ones that we're getting the clips from the Ways and Means Committee, and there's lots of interesting stuff there. They're coming after that one with that.
Okay. Yes, and it wouldn't even translate to that much tax revenue, and it would only be applied. It would start basically on December 31st, 2021. So this year, all of the transactions we would do are fine, but we still think there's opportunities for tax loss harvesting, even if there is a wash-show rule. So that's what we think is interesting, and tax management, tax loss harvesting is a big piece of what we do as a firm. So very complex when you're moving it from a custody account to an exchange account, even if you're rebalancing or trading and having very little slippage associated with it. And we also have no transaction fees because we have so much volume with the liquidity partners that we work with. So there's no 50 bips, you sell, buy back, then you're paying 1% round trip.
So you're not diluting the tax loss harvesting potential by actively trading that frequently.
That's exactly correct, yes.
So let's shift gears to strategy a little bit. Again, I'm going to assume that people watching this have some familiarity because I think there's a broad level now of familiarity with cryptos. But I think for those of us that aren't technologists or maybe deeply involved in the industry, cold storage versus a hot storage or hot wallet, how you guys process that. So let's start with just some definition of terms because you already mentioned cold storage. Just make sure people understand real quick, just in a broad level, the two primary ways of owning and kind of holding and storing Bitcoin. So walk us through those a second. I'm going to start then hitting some strategy questions.
Yes, so there's two ways to hold digital assets in Bitcoin. One is in a hot wallet, which is connected to the internet. The most common one is a Coinbase retail account, right? That is a hot wallet that's connected to the internet. You have to do all your operational security for your assets, and these are bearer assets. So if your phone or email gets hacked with a retail exchange account, you can potentially never see those assets again. So there's no recourse with Verizon or Gmail or one of these exchanges. So there's high risk in holding it in a hot wallet. We hold it all in cold storage, which means it's not connected to the internet. It's offline from the internet, which means hackers can't get into your Bitcoin if your phone or email gets hacked, or our phone or email gets hacked, or your advisor's phone or email gets hacked. So that's one piece of it. And it's the way to think about what it looks like is it's a small USB drive. It's called a hardware security module. It's held in tier 4 data centers that are geographically distributed across the US with very high levels of access persons into those SOC 2, Type 2, Type 1 reviews for all of the operations. So that's a big piece of when we were deciding who to partner with, going through all the operational security and custody security for a cold storage account is a big thing. And then also as a RIA, and you're an RIA, making sure you're following the SEC custody rule. Assets always have to be at a qualified custodian. Our assets are always a qualified custodian. They're always held in cold storage, right? Unless we're rebalancing for that short period of time or doing tax loss harvesting. So it's a big piece of this being approved by RIAs and having advisors and their clients feel comfortable that this is the safest way possible to hold it, and was extremely strong operational
So you mentioned
security.
something that gives me another question. So if it's in cold storage, it's not connected to the internet, it's in a essentially a USB drive stored in a very secure location. How is there a lag time then if a client says, hey, I need to liquidate some of that to cash, or when you guys are doing your rebalancing? Just walk us through kind of what that process looks like, kind of operationally. Is there a 3 to 5 day kind of like delay and lag between maybe I need some liquidation or I want to trade and you guys being able to execute it? What does that look like?
I'm glad you asked that because it's a big piece of the technology we built on the back end where no one can see it because it's all back end technology. But we built out a feature that is instant liquidity, meaning that if you have 100K in Bitcoin and you wanted to rebalance into 50 Bitcoin Ethereum, you can do that instantly from cold storage. So it stays in cold storage and then it gets trued up at the end of the day at 4:30 p.m.
Got
Eastern.
it. So you guys are essentially processing the trading records and doing the allocations and then adjusting the cold storage after the fact.
Yeah, it's like balance sheet basically true up on the back end.
Interesting.
And then if you want to liquidate your position for whatever reason, you want to take profits, you no longer want to be allocated to this asset class, it's daily liquidity. So we'll sell, move it into cash, and then wire it back to your bank account, which typically you'll get it next day, but that's how it
Okay,
works.
fantastic. Types of accounts allowed. Can we do this in IRAs, Roth IRAs, or does it have to be taxable accounts?
Yeah, so every type of registered account, we have a digital onboarding process for where I know you built that out as well, so we have very similar technology. But being able to onboard those accounts in minutes and very ease of access for advisors is top of mind for us because we're very advisors focused and want them to have a good experience. So we take individual, joint, trust. Trust is actually our most popular account that we onboard. LLC, we work with nonprofits, we work with corporations that add Bitcoin to their balance sheet, and then IRAs, so SEP, traditional, Roth, all of those is what we've done, and it's a beautiful onboarding experience for that. So the qualified accounts has been a lot more popular.
On the qualified account side, are you guys having to use an additional custodian that does the self-directed side, or is that something that Gemini, who's your custodian on the digital asset side, is now handling? So do you have to have like a Kingdom Trust or an Entrust or an IRA group, like a self-directed kind of custodial account setup? What does that look like?
So we're partnered with Alto IRA, where they custody the IRA account, but Gemini custodies the actual assets. And when we're multi-custodian, it'll be the same structure. There's no digital asset custodian that also is an IRA custodian. So it was clunky to get set up. It took us about 8 months to get it set up, but now it's a pretty beautiful experience. You just fill out the form, sign the agreements with Eaglebrook, Gemini, and Alto IRA, which is just one form. The transfer of assets goes through to Fidelity, Schwab, TD, Pershing, whichever custodian you're working with. And then once those assets get to Alto IRA, they're wired to Gemini. Then we invest them. And from a RIA's perspective, they're held the same way as they would be held in an individual or joint account. It's just this extra step because it's custodied at that self-directed IRA custodian. Because if you want to invest in alternatives, any alternatives, private equity, venture capital, real estate, startups, direct deals, crypto, you need a self-directed IRA to do that.
Some of the stuff that I've been reading from the proposed tax reform changes are also taking aim at self-directed IRAs. Is there anything in that you guys have seen there that might impact holding crypto assets inside of an IRA?
I don't believe so. I haven't seen anything on crypto or digital assets specifically. It could potentially be towards like contributions and things like that. However, mainly it's like a transfer of assets of 50, 100, 250K from their traditional IRAs, and they're just moving over and investing that. I don't think that will have a big tax impact because it doesn't really change the rules around how you can invest in your IRA and add assets.
Yeah, awesome. All right, some strategy level questions. I've been to a couple of Rick Edelman's, I think it's called Readact now, the RIA digital asset council events. And in the early stages, so rewind maybe 2.5 years ago when he started putting these on, there was some stuff that was put out there to help advisors try and think about the size and positioning of an allocation to, say, Bitcoin in a client's portfolio. And I'm not going to say that it was rudimentary, because I really don't think it was. It was designed to be a simple illustration of like, hey, allocate 1% of your client's assets to Bitcoin and the rest of the S&P, and here's what the outcome looks like. So my question is this: with cryptos being, and let's just pick on Bitcoin specifically, because I think it'll be easier as a proxy, with Bitcoin still being relatively new as an asset class and relatively new from more of an institutional investment perspective, how should I, as the advisor, be thinking about sizing and positioning in a client's portfolio, right? And even if I maybe specifically say like the long end of their portfolio, right? How do we start even thinking about that? What are some ideas there?
So we do a lot of work on portfolio implementation. Kind of starts with, where am I taking this out of first, right? Yeah. Is this in the alternative bucket? Is it in the equities bucket? Is it in the fixed income bucket? We see a lot of people take it actually from equities. Yep. Some that are more heavily focused on alts, they'll take it out of the alts bucket. And then from there, we will take their model portfolio or their discretionary portfolio and run an analysis on it. What we recommend is anywhere from 2, 4 to 6% allocation. It's not a one size fit all. Every firm is different. Every client is different. Are you doing it in a model portfolio or discretionary portfolio? Or are you doing it on a client by client basis? 2% is the obviously a little more risk averse side, yep. But we still think that clients it's suitable for 2% allocation does have a material impact and an improved Sharpe ratio. All the different risk metrics, all of those things. 4% I think is where we see the most advisors that are allocating. That's what they choose because it's a little bit more conservative from the 6%, but has the max benefits from a Sharpe ratio perspective. Mm-hmm. It only increases the standard deviation, which is the risk of the portfolio, by 60 basis points. So it's a 4% allocation. This is obviously a very volatile asset class, but when we talk to our clients, and that's why I love our advisors and clients so much, is that they're not looking to just do a trade and hold for 12 to 18 months. This is something they want to allocate to for the next 5 to 10 years. So we have no one that's liquidating the account when there's volatility from 64K to 30K to 52 to 42. This is a long-term investment, and we can get into where we think it's going, but that's where we're seeing that. And then the 6% is, I would say, for the more risk-tolerant investors, younger investors, or higher net worth investors that really understand this investment in this asset class. Anything above that, we see that the risk becomes a little bit too high given the volatility. So the advantages of that kind of mix in a portfolio stops at 6. Mm-hmm. So anywhere from 2 to 6% is what we see. In practice, when we do our customer interviews, we're actually seeing between a 4 and 5% allocation, which I think is really interesting, mm-hmm. because it does take time for people to understand this. But when they're ready to allocate, where they say, hey, I want this to be a meaningful position in my portfolio. I understand the investment thesis. I understand that adoption is growing just as fast as the internet was in the late 1990s. So this is somewhere I want to allocate, betting on this technology and this asset class becoming an important part of our digital economy over the next 5 to 10 years.
Correlations, right? I've seen stuff out there talking about how Bitcoin is an uncorrelated or has a negative correlation to different major asset classes. I haven't actually gone in and researched this. I'm not an expert by any means, so I'm just asking, which I think is a great way as the person doing the interview. How correlated has Bitcoin been to, say, the S&P 500 in the last 18 months with COVID? Did we saw pretty much every major asset class in March of last year got smashed at the same time. Everything became pretty correlated, mm-hmm. even treasuries, to the S&P 500. How has Bitcoin been in the last 18 months as it pertains to correlation relative to the U.S. equity market?
So we do a 5-year rolling correlation, so I have those numbers. And basically, if you look at everything, fixed income, commodities, S&P 500, it's close to zero, right? So it's a non-correlated asset, depending on where we are in the cycle. But if you look at it 5 years, it smooths out. It's very non-correlated with the S&P 500. Okay. However, when we have Evergrande or COVID, everything's going to get correlated. I want to make it very clear: Bitcoin and crypto is a risk asset.
Yeah.
Some people say it's a hedge and a risk-off asset, right? But no, it's a risk asset. When the S&P falls, Bitcoin will fall more. However, something interesting that we're seeing in a lot of macro events in the past, right? Like Greece and other, China trade in 2018.
Yeah.
It will take that initial dip even further, but it will perform better coming out of the dip because it's not tied directly to a certain geography or financial market, right? It's a truly global new monetary asset. So it's not as correlated coming out of it and will perform better, but correlations go to 1 in a sell-off with risk assets. So It's pretty clear.
Well, I appreciate you approaching it that way and kind of delineating, because I think the idea of something hedging another investment, I think really needs to be interrogated, right? Like, what actually are you hedging if you're looking at crypto and Bitcoin as a hedge, like a hedge against what, right? My personal viewpoint is that it has some very interesting characteristics of hedging against, government, monetary policy, government intruding into our transactional lives, et cetera. So let's talk about this one a little bit. I almost hesitate to bring up well, let's not. I was going to say the individual who died in Spain, who was, theoretically on the lam from the U.S. government for tax evasion. As governments try and regulate this more, and one of the appeals of crypto is you can essentially have this ability to take your assets with you anywhere in the world, right? How do you see government trying to control this? China would be an example. Do you see the U.S. kind of going in some of those directions too, and saying we have to control the ability to make these transactions and to take wealth outside of the country for tax reasons, policy reasons? Talk to us a little about that. Maybe even expound a little. It doesn't have to be exact science, but what are you, Chris King, from all of your research, talking to advisors, dealing with the SEC and regulatory stuff, like, is crypto really going to be a hedge against bad government policy and the debasement of the dollar or something like this? Can it be thought of that way?
Philosophically, yes, that's what we believe. We believe that Bitcoin is an inflation-resistant store of value. However, it's not a store of value yet. It's an emerging store of value, which means it can be defensive, right? It's scarce, it's non-correlated, which can reduce exposure to economic cycles, and it is non-sovereign. Like you said, it's a global asset, right? People can send Bitcoin from here to El Salvador in seconds, right? It's just a global monetary asset, but it's also very scarce, right? And has a transparent monetary policy where there's only ever going to be 21 million Bitcoin. So a lot of the advisors we work with, that's how they view it, is that kind of inflation-resistant asset plus growth and upside as it takes store value or as it takes market share from gold and other stores of value like real estate or other financial assets. The different jurisdictions and geographies have different rules. I don't believe the US will ever ban Bitcoin, just like I don't think they're going to ban gold, right? They're very similar in that sense where they're just kind of these monetary assets that are alternative, but they can be, inflation resistant in some areas as Bitcoin's network grows, the trustworthiness grows, the acceptance, adoption, all these things as an asset that is native to the internet that I believe is going to protect against potential debasement or inflation. So that's how I think a lot of people view it in the US. What I like to say is that everyone in the world owns Bitcoin for a different reason. So if you're in Venezuela or El Salvador, you own Bitcoin for a different reason than someone like in the US would, where you're looking at it as part of your portfolio. They're looking at it as somewhere where...
Means to buy groceries.
Exactly. So I think it's not going to be a medium of exchange for some time until we're in the multi-trillion dollars of market share, because you wouldn't want to sell something that you think is going to appreciate, right? Whereas you spend dollars because there should be 2% inflation and you're incentivized to spend your dollars, right? So I don't think Bitcoin is going to be a medium of exchange for some time. It needs to become a store of value first, then medium of exchange, maybe in 20 years, then global union of account. I don't think Bitcoin is going to take over the US dollar or the euro or the yen or any major currencies like that. I think it will just be a big part of the digital economy and the macro landscape, similar to gold, as opposed to, hey, Bitcoin's going to take over the world, hyper-Bitcoinization. Everyone is going to have to pay for their coffee, their car, their computer with it. So I think the U.S. is actually going to be very friendly with their regulations moving forward. But other jurisdictions like China and other more authoritarian jurisdictions, the reason they own Bitcoin is that you can own $5 million worth of Bitcoin, leave the country with the Bitcoin in your head, go to another jurisdiction and collect your assets. If you wanted to do that with gold or US dollars or anything else.
Yes.
So people like to say for people outside the US, it's a Swiss bank account that's in your head, which is very advantageous if you're trying to move across borders. And as we become more global and self-sovereign, that's where I think we're
even
headed.
here in the U.S., I think my limited reading on this seems that from a government perspective, it gets oftentimes lumped into the nefarious actors club, right? Like it's the bad people, it's the gangsters, the drug dealers, the terrorists, the human traffickers that are using Bitcoin. And maybe it is, maybe it isn't. But it seems to me that this idea that you could leave the country with your passcode in your head, collect all of your assets in a different country scares even the US regulators from that perspective, right? I mean, I think maybe China is just cracking down on it first because they're getting ready to roll out their own version of some type of, digital yuan, right? Where's the Federal Reserve at in some type of Fed coin or digital US dollar?
So I think all the central banks are looking at it.
Yeah.
However, it's not actually a cryptocurrency like Bitcoin because it just provides more tracking for the government. It's not like you're going to be able to use it, everywhere and custody yourself. So I think it's just maybe an incremental improvement on the current US dollar. But US dollar is electronic. I mean,
it's digital already.
I pay for 98% of my expenses with my credit card, right? So it's kind of already digital. So it's what I think could be really interesting is that as they create these digital dollars, digital renminbis, it just makes it a lot easier on-ramps to own Bitcoin and Ether. So it's almost could potentially backfire, even though there's going to be a certain level of surveillance on the digital dollar, Fed coin, things like that.
I mean, the government's been tracking, cash transactions and deposits and things like this. I mean, anybody who's been in our industry any length of time has had to sit through an anti-money laundering class, a Patriot Act, CE or something like this. So we're highly aware that the tracking of dollars is very easy for the government to do, and the tracking of crypto is not, until somebody has to convert it to the local currency. And that, I think, is the weak point maybe in the system, right? Is if somebody was truly looking at this as a hedge against nefarious government policy, like it's great to have everything in, maybe it would be great to have everything in Bitcoin until you need to pay taxes or buy a piece of property in that local country and somebody needs you to turn your Bitcoin or your digital assets into traditional currency, right?
Well, I would actually push back on one comment you made where Bitcoin is actually not used for nefarious activity, less than 34.34%, 34 bips. A study by Chainalysis that said that it was actually used for nefarious activity. That's a very small portion of the network.
I should clarify. I don't actually think it is. I think that's what I've heard.
It's a FUD. It's a common client.
It's something that it's and it's also something that that different politicians have made kind of that aspersion about cryptocurrencies, right? Is that because it's kind of in this secretive, it can be, it's not traceable like dollars and stuff like this, that only bad people are using. I actually don't think that's the case, just to clarify. I think that's the government's way of saying we should be able to regulate this more kind of thing.
Well, it's actually easier to track Bitcoin transactions used for nefarious activity than cash, right? Because cash is untraceable, right? But Bitcoin, it's a fully open ledger that everyone can see every transactions. While they are pseudo-anonymous, certain firms like Chainalysis and other data companies that work with the NSA, the DEA, the FBI, the CIA to be able to track this. For example, when that pipeline was hacked and the hackers got $5 million of Bitcoin, that was recovered, I think, within 24 hours. Because they can track that even if you're trying to put it through mixers. Mixers are just things that shuffle the transactions around so you don't know where it went. But that was a big thing that I think people that do engage in nefarious activity saw. They say, okay, we're not going to deal in Bitcoin anymore. We're going to stick with US dollars, which is typically how different types of cartel and things like that.
Yeah, the government doesn't want competitors in the monopoly for bad acting. Okay, how do I value? Let's use Bitcoin again as a proxy because there's hundreds and hundreds of coins. How should an advisor be thinking about the size of the market and where the current value of a Bitcoin is at relative to that? How do we go about valuing this asset class?
There's different schools of thought, like stock to flow. We more look at, it's a little bit more qualitative, but adoption numbers and Metcalfe's law, because Bitcoin is a network like Facebook, like Uber, like Instagram, right? That's how Bitcoin has gotten this viral, basically, adoption, because it has network effects, because it's fully digital. I can store, send it, all the internet. I could send you, $20 worth of Bitcoin right now very easily. And every new person that joins the network adds value to the network, right? So, for example, back in the early 90s, if only 3 people had email, not a lot of utility, not a lot of value. But every person added increases the value of that network. So we look at Metcalfe's law and adoption very closely. In terms of market opportunity, the most obvious one is gold. Gold has an $11 trillion market capitalization. We believe that that's kind of the first piece that Bitcoin is going to take, right? Kind of the first chess piece that will somewhat fall. We think Bitcoin should be valued somewhere around there over the next 10 to 20 years. So that's kind of a relative basis you can look at that by modeling it after Metcalfe's law and adoption. The number that came out in 2020, which we follow, the adoption and how many people hold it, is that 130 million people across the world, 200 countries, own Bitcoin, right? That was in 2020. Obviously, we had a crazy first few quarters of this year. Numbers that are coming out are anywhere between 200 million and 260 million. Okay. We're still putting that data together, but it could potentially be 100% growth rate, which would make the value even more valuable if you look at it from Metcalfe's law perspective. And then stock to flow looks at Bitcoin's scarcity and supply, similar to gold, how gold can be valued in certain ways. Yep. But what's interesting about Bitcoin is that we know exactly how much Bitcoin is going to be mined every day.
We have no idea how much gold's going to get pulled out of the ground.
Exactly, and if there's less demand for gold, right, there's less mining. If there's more demand for gold, there's more money. So the supply rate of gold fluctuates. The supply rate of Bitcoin does not fluctuate, and every 4 years, Bitcoin's incremental supply reward gets cut in half. So the last one happened in May of 2020. The next one will happen in March of 2024. Every 4 years until 2140. By 2025, Bitcoin will actually be more scarce than gold, measured by stock to flow ratios. So it becomes more scarce, it's disinflationary. Yep. And from a macro perspective, the central banks and the fiat system is moving in this direction from a supply perspective, where Bitcoin's supply rate is moving in this direction, which is when that clicks for advisors and the investor clients that we work with, that's a very powerful chart that we use for people to understand, okay, that's what I'm investing in, a scarce asset that eventually will be globally adopted and have success as this actual monetary asset that can be inflation resistant and can eventually be a medium of exchange used in, I would say, different countries, probably not the U.S., but El Salvador just did legal tender. Ukraine's talking about it. We think a few more countries, but it's a slow process. There's infrastructure, there's education. So this is a 20-year investment and global network that we're going to see thrive, I believe. So it's going to be very interesting to watch the next few years.
Do you see the valuation of Bitcoin being a zero-sum game against gold? So you mentioned one of the metrics is kind of looking at the cap market, the cap size of the market for gold, 11 trillion. Do you think that it's going to directly kind of be a zero-sum game where it's going to pull the valuation of gold down? Or do you think it's just something that'll kind of be an analogous proxy where the Bitcoin will eventually catch up to where gold sits in terms of market cap and size?
I think it's going to be a proxy. Okay. Something interesting is that most advisors don't own gold or have a gold position. So it's not like, hey, sell your gold, buy Bitcoin. We'll almost always see it moving from either their cash position or their equities position. So that's kind of where it's coming from. There's $99 trillion of M2 across the world. So it'll be partially coming from that. But obviously, if you put $10 billion into Bitcoin, it doesn't just increase the market cap by 10 billion. It can increase it by 5, 10 times that amount. Yeah. So net new capital moving into the market is something that we watch very closely. So I think they can actually grow in comparison, where it's not like,
it's not going to be a zero-sum game.
No.
One's going to at the demise of the other.
And gold has industrial and commercial use, jewelry, that will always happen, but that's actually not even the majority of gold use is actually for monetary premium and those purposes. So that's the piece of gold that we think it would be Bitcoin would be taking market share from.
Over the last 18 months, maybe a couple of years, and I have no insider knowledge on this, just me reading, larger institutions, and there's been a few, venture capitalists, private equity, kind of big hitters on Wall Street, like Mike Novogratz and some of these people that have been very bullish on,
Paul Tudor Jones, Drunken Miller.
Yeah. But it seems like in the last year and a half that some other big names have kind of stepped in and said, hey, we've now looked at this and realized this isn't a fad, this isn't, a scam, and their institutions are allocating. Talk to us a little about the institutional adoption and flows that you guys are seeing, as you're doing your research there. How is the large firms, family offices, hedge funds, institutional investors approaching this asset class?
Yes, so there's very different ways you can enter this market if you're an institutional investor. I think a lot of the endowments, insurance companies, pension funds, kind of the traditional institutional investors, a lot of them aren't buying directly. They're investing in certain funds in the space to get exposure because it's a little bit easier. It's a little bit more familiar with structure. Yep. Their mandate doesn't have anything that says own digital assets directly. However, I think that will change where they'll actually want to own it directly, and they'll want to probably own it in a separately managed account structure so someone can actually manage that part of their portfolio as opposed to hiring someone in-house and managing that. So I think what we've seen at the beginning of this year is a lot of the hedge fund guys, Alan Howard, Stan Druckenmiller, Paul Tudor Jones, them taking big positions in a lot of their peers, Ray Dalio, things like that. That was kind of one piece of it. And then we saw the corporations come in, Tesla, MassMutual, MicroStrategy, Square. Those all made public announcements when Bitcoin was like above 40, 50, 60K. Yeah. That hasn't stopped. Those corporations, probably not public ones, but more private ones from what we're seeing, are actually adding Bitcoin to their balance sheets. They're just waiting for the price to go back up and reach new all-time highs before they announce and say, hey, we bought it at 35K or 40K. We made a good investment from a balance sheet strategy perspective. So those are two areas that we think are interesting. We work with a few corporations and nonprofits as well that are allocating to this market. It just is a longer process sometimes to get it approved from that perspective. So that's kind of the institutional demand and institutional adoption because they're very sophisticated investors and they understand the defensive aspect of it, right? Low correlation, scarcity, non-sovereign, but also, hey, this has advantages over gold, right? This is a global asset. We want to hold it in our portfolio because it can actually improve risk-adjusted returns. So we're starting to see more corporations move into this market. Traditional asset managers, we're working with a few traditional asset managers to move into this market where they can run their own crypto strategies on our SMA platform. So I think the next 6 months is going to be really interesting, seeing how various participants move into the market. And we're, I think, ignoring the largest market, which isn't the retail market or the institutional market. It's the market in between with this wealth management market. It's a $29.1 trillion market in the US. That is a lot of capital that has been on the sidelines because there's no great solution for advisors. So that's what we work a lot on, is helping that capital move into this market in a very institutional, secure way, educating those 100,000 plus financial advisors on allocating. So I think one of the strongest drivers of net new capital and demand is actually going to be from the wealth management industry, which it's not institutional. It's not really, you're a 5, 10 grand retail client on Coinbase. It's somewhere in between where our average account size is 150,000. So it's a little bit higher net worth individuals that we're working
and
with.
as that capital flows in, obviously the network effect takes over, driving the valuation, the user adoption rate, stuff like that. The title of the podcast of our video series, The Future of Advice, I'm going to shift gears just a little because we're at a spot where I think this makes sense to do this. You've hinted and you've maybe even said a couple of things along the interview so far about where you see blockchain and Bitcoin going. Take us forward 5, 10, 20 years and give us your view of where you see the value of Bitcoin, and we'll use Bitcoin again as a proxy for digital assets, where you see Bitcoin sitting alongside of major asset classes, how you see it impacting advisors and financial firms and consumers.
Yes. So from a I would say valuation perspective, I never put out price targets. That's something we never do, but we think it can be on par with gold over the next 10 to 20 years and act in a very similar way, but have much stronger utility in that transparent monetary policy, right? So that's kind of how I see it fitting. Doesn't need to be too complex. It's digital gold, and if you allocate, at this time period, we think it's still early, so it would actually help improve the risk-adjusted returns of your portfolio. Mm-hmm. And then from an advisor's perspective, we think that it is no longer an offensive play to get educated on this asset class and provide access. It is defensive because everyone's going to have this. You need to start thinking about this. What we see, and I think the most interesting things with advisors is what's the most important part of an advisor's job is to build and engage with their clients, build deep relationships. Yeah. And you can do that in a bunch of different ways where maybe the crypto portfolio is only 4 or 5%, right, of their portfolio, but the client wants to talk about it 80% of the time. So you can build and engage a lot deeper with your clients, build lasting relationships. They view you as smart, as experts. Maybe because you understand this, they'll move assets from another advisor. So we actually view it as a major business opportunity because the next gen advisor can engage with their clients at a deeper level as opposed to them just saying, oh, I don't know anything about Bitcoin, go buy it on Coinbase, right? So we think it's a major business opportunity and a way to strengthen those client relationships and engage.
Interesting. What do you think the challenges are today for advisors getting in? Is it just education? Is it the compliance hurdle? Is it that most advisors are part of large firms and it just takes those large firms a long time to kind of work through the process and allow their advisors to engage us? What are the biggest challenges that you see advisors facing still in this space?
So it's actually, I would say, not advisors. It's more the home offices. So we've gotten approved by 34 RIAs that manage over $150 billion, so larger, RIAs. That's a big piece of it, and we're working on probably 70 other active deals. It's caught up on is the compliance and the diligence aspect of it. Is it too risky? How do we do this? So walking them through that, I would say that's one of the biggest hurdles for every advisor in the U.S. to actually have access to high quality products, in my opinion. So we think that's the big thing. And then the short answer is that a lot of the wirehouses and IBDs just haven't approved anything, but we believe that they will in a short period of time. So once something is launched and it's approved and you can access it, then it's education, which it's not just a 1 hour educational course like we provide. It's like 20 hours of podcasts, videos, reading white papers. So it's a little bit more work, but right now it's maybe, let's say, anywhere from 2 to 6% of the portfolio. As every asset gets digitized, tokenized, is now operating on a blockchain, that could be 20% of the portfolio 10 years from now. Yeah. If 20% of your portfolio is what your clients own and you don't know much about it, you're going to get left in the dust. So next gen advisors really need to think about how this industry is evolving. Do they believe there will be money market funds on the blockchain, right? Can there be other types of assets on a blockchain? Could there be, these DeFi assets that become more mainstream on this blockchain technology? And that's all fits within kind of what we're doing now. If you can understand Bitcoin and Ethereum, down the road, you'll understand, the other 15% of the portfolio as those investment opportunities come online.
So that actually is a great point. There's conversation out there about how the blockchain and the technology that's behind, say, Bitcoin and Ethereum, et cetera, is going to potentially alter how our industry functions. Thinking about trading as an example, right? Having an exchange, that exchange then passing the trades to the books and records then passing the information to the custodian then passing the start of day files through the advisor via like Orion or whatever. There's massive disruption potential here, is there not, for this technology to change how we have proof of ownership of a trade or of a stock? What are your thoughts on the technology behind Bitcoin, Ethereum, and cryptocurrencies truly actually being adopted for other aspects of the wealth management space, specifically like ownership of assets, trading, things like this?
Yeah, I'll touch on trading specifically. So, various DeFi exchanges, DEXs, right? Uniswap, SushiSwap. What they're doing is it's these peer-to-peer markets where they are fully automated, right? They're fully trustless. There's no intermediaries. They have liquidity pools and AMMs, automated market makers, that provide deep liquidity for these various assets. While right now a lot of those assets aren't stocks, bonds, or anything like that, we eventually think that they will move into that over the next 5 to 10 years. And it's final settlement right after the trade, right?
Yes.
You can audit everything because it's on a blockchain, right? There can be more liquidity because it's kind of coded into the decentralized exchange. So we think right now a lot of the use case is trading lower liquidity digital assets, right? Kind of more in the DeFi space. But the technology is there and the liquidity is there is where something like Uniswap is starting to compete with Coinbase on trading volume. So that can potentially move towards a regulatory framework, which we don't have right now, for them to be able to trade Tesla and Apple and those stocks and run a portfolio where you can have that 70% in equities, the 10% in crypto, and then fixed income and other alts, all within this trading platform. But there's a lot of questions around operational security, custody, trading. So we don't do that for our clients right now. We are building technology to be able to do that in a compliant way, but we're really waiting on the regulators to say, hey, this is how these DeFi and global decentralized exchanges should be operated. These are the rules that you need to operate within so you can actually use this. So I'd say it's 5 to 10 years down the line, but it's much more efficient than the current system.
Yeah, interesting. All right, a couple more questions for you, wrapping up here. We talked about digital assets and emerging technology. What do you see as the role of a financial advisor or a wealth management advisor in the future, right? So you're in this space where you're touching on, what I would consider to be one of the newest asset classes of disruptive technology, and one of the oldest traditional, industries and structures being an RIA and on the wealth management side. I ask this question of every guest. What do you see the role of the advisor being in the future?
So I think about this a lot. This answer is probably a little bit different. And as you know, every advisor is different. Some really focus on planning, right? Helping people hit their goals. Some really like the investment management piece and diligencing alternative investments and sourcing deals for clients. Some are really good at tax management and estate planning. So there's kind of different ways that this can evolve. I think something's interesting that I don't think many people are doing right now is actually adding a aspect of career type coaching to the financial management and financial advice, where what we're focused on as advisors is really helping you save, helping you grow your portfolio, but no one's focusing on the top line, which is increasing your income, right?
Interesting.
So I don't know if advisors are the best suited to be a financial advisor and a career coach, but I think that is a really interesting way that people can differentiate themselves. And it would probably be in a specific industry where it's, so this one person, maybe he only works with investment bankers and private equity guys, and he is really connected within that community. He can help them navigate, right? Understand how to increase that top line, going to the right firm, and it could be tech sales, it could be dentistry, right? It doesn't matter what industry, but that's something super interesting where it can help you build your practice and build your AUM because your clients are making more money, and you're guiding them through that process on career coaching and things like that. I know there's also some things around like wellness and health and things like that. But I think really, everyone focuses on making you save more and, more like bottom line, all that stuff, planning, but no one flips it on its head and looks at it from a top line perspective and helping you increase your revenue or your income. So super interesting.
That actually is really insightful because we can do amazing work to the bottom line. We can save taxes. We can encourage them to save more. But if you don't change the top line number coming in for a client, right, you're essentially capping out the growth trajectory of the value of that client's assets and even theoretically their value to your firm.
Yes.
I can see that being really powerful, especially for people that truly operate inside of niche industries, right? Being able to understand compensation arrangements and pay and how to leverage those things. That's an interesting one I'm going to spend some time thinking about. What keeps you up at night? What are the things that, besides the startup nature of running a technology / RIA startup company, what are some of the things that keep you up at night that you worry about, both whether it's for our industry or for your business specifically?
Yeah, so I don't think it's anything to do actually with regulation. I don't think Bitcoin's going to be banned. I also think there's a low probability that Bitcoin goes to zero. So those aren't really the things that keep me up at night. I would say it's more running a business, right? Hiring people, making sure that your employees are happy, and really building a strong culture. As a younger entrepreneur, trying to navigate through that is difficult. Am I doing this correctly?
Yeah.
Am I, managing the team correctly? Am I making everyone as happy as possible? Because when it comes down to it, the reason why I want to build a company, aside from making my customers and clients extremely happy and providing a solution for advisors that they previously didn't have and a beautiful experience, helping them build their practice and educate them. It's really about building a really strong team, help people do their best work and enjoy actually working at a firm. So that's what I would say keeps me up at night, making sure that I'm doing that correctly and keeping everyone happy. So I absolutely love it, but that's probably what keeps me up at night. Nothing related to the crypto space, which is good. I mean, when Bitcoin fell from 64 to 30, had some sleepless nights, but we've recovered and obviously understand that this is volatility. I've been in the 2014 market cycle, the 17. So when I see that 50% drop, it doesn't faze me. But when clients see that, it's kind of like, whoa, what's going on? What's great is that we can do the tax loss harvesting, so they're happy about that, and they own the same amount of assets. And every client that we work with, 5+ years time horizon, so really aligned with our clients. We've had no withdrawals since we launched in November of 2020. I think maybe one client took profits, right? Because he invested at 10K, right?
Yeah,
So.
no, that's awesome. Final question. If you had to recommend a book or some reading, doesn't have to be specific about cryptocurrencies, what's a book that you would highly recommend to the people listening, with advisors, people running firms, that you would say definitely put on the read list before the end of 2021?
So I think one of the initial books that got me into technology and entrepreneurship is called 0 to 1 by Peter Thiel.
Yes.
I don't know if it's extremely relevant for advisors, but advisors are entrepreneurs, right?
Yes.
And it's, this is a competitive market. The whole book is about how do you do things where you don't compete, right? It's not an extremely competitive market, while having the perception that you're competing with everyone, right? Yeah. So I think that's what we try to do as our firm is, it's not even differentiation, it's that how do we build such a strong moat that we're not competing with anyone, but then we trick everyone to think they're competing with us, and then we blow past them in a certain way because we just have better moats, better products, better customer service, whatever it might be. So I would say 0 to 1 is probably my favorite book. It's a short read, and Peter Thiel, one of the top entrepreneurs of our time.
Yeah, soon to have IRS tax laws written after his Roth IRA play.
$5 billion in an IRA. So.
Well, I love that book. I read it years ago, and it was super impactful on me. And I think it's a good recommendation for advisors, because I truly believe that the industry, whether you're a young advisor just starting, or a career changer, or somebody that's been in the industry a while, I really believe that the future is just absolutely an amazing opportunity for advisors to serve clients in unique ways. And so I do like the suggestion. I love the book. I love the idea of encouraging advisors and reminding ourselves to keep innovating and to build big things, right? Because the opportunity for it is fantastic. I absolutely love this interview. I wish it wouldn't have taken us 18 months to get our schedules aligned. Thanks for making the trip in today and sharing your knowledge and background in the crypto space. For those of you that are watching, again, I've been interviewing Chris King, the CEO and founder of Eaglebrook Advisors. If you'd like to learn more about Eaglebrook Advisors, you can find them online at their company's name. You guys are also on Twitter, correct? You have a Twitter handle?
LinkedIn, yes.
Yeah, Twitter and LinkedIn. We'll post some of that in the show notes and put it out here. I'm Ron Bullis, the CEO and founder of Lifeworks Advisors. I hope you enjoyed this wide-ranging conversation on digital assets, cryptocurrencies, running a technology startup and an RA startup, and look forward to having you back in another Future of Advice episode. Chris, thanks for being here.
Thank you, Ron.